The Chinese stock market has been on a tear recently. Since the start of this year, the Hang Seng Index has gone up by almost 25%, while the Hang Seng Tech Index has gone up by over 32%. All that in the past 3 months alone. On the flip side, the S&P 500, which is supposed to have the world's biggest and best companies, have been struggling and have even temporarily fallen into the correction territory. So what is going on in China? Is China all of a sudden investable now? And more importantly, can this China bull run continue, or is it just another bull trap? After all, the previous 2 bull rallies ended up with a disastrous drop of 30% or more. But before I start, do join my 10,000 members Telegram chat group to discuss or ask any questions that you may have. Before we talk about why the Chinese market has been rallying recently, let's first understand why the Chinese stock market has performed so badly over these past few years. The first and possibly biggest reason is because there was a loss of investor confidence in the Chinese stock market due to a series of government policies and regulatory crackdown. For example, there was the property sector crackdown, where the Chinese government introduced the 3 red lines policy to limit how much property developers could borrow. This policy worked too well to the point that it triggered a real estate crisis and even caused the biggest property developer, Evergrande, to default on its debts. As a result, home buyer confidence collapsed, property prices fell, and with real estate accounting for around 30% of China's GDP, this contributed to a slower economic growth. Then there was the big tech crackdown, where the government targeted major internet and tech companies such as Alibaba, Tencent, Didi, and Meituan in an attempt to curb monopolistic practices and address data security concerns. This wiped out trillions of dollars in market value, and foreign investors started becoming wary of investing into Chinese tech stocks, as they now realize that Chinese stocks carry one additional risk, the autocracy risk, where the government could just suddenly come in and impose sweeping regulations whenever they want. Then, there was also the private education crackdown, which wiped out for-profit tutoring companies overnight, gaming and entertainment industry crackdowns, and the zero-COVID policy. And the result? Fund managers started cutting their exposure to China. China's GDP growth slowed significantly, and consumer confidence dropped, as people are hesitant to spend or invest their money. Though, interestingly, this isn't the first time the Chinese government has done such things, and investors seem to forget that the Chinese government has been doing this all this while. For example, back in 2015, China regulators had ordered Tencent and Alibaba to crack down on counterfeit goods on their e-commerce platforms. In 2017, the government forced Tencent to limit gaming for minors, and in 2018, regulators froze new game approvals for 9 months, hurting Tencent's gaming business in the process, just to name a few. Because of all these negative sentiments, the Chinese stock market was trading at record low valuations. Same for individual Chinese names like Alibaba and Tencent, where they were trading at a -1 standard deviation, prior to this run-up of course. But then, unbeknownst to most people, something interesting was happening beneath the surface. And if you hadn't been paying attention to China, you would have missed out on this. Quick pause, if you're looking to kickstart your investment journey, you can check out Weibo. First, Weibo offers a wide range of markets for you to trade and invest in, such as the Singapore, US, China, and Hong Kong markets. Second, Weibo offers low trading commissions. You can invest in US stocks and ETFs from just 50 cents per order with zero platform fee during regular and extended hours. And for the other markets, their pricings are also one of the most competitive as well. Third, Weibo has a ton of useful features to help you in your investing journey, such as technical analysis, fundamental analysis, analyst ratings, up-to-date news, and more. New users who sign up to Weibo now will get up to $600 options trading vouchers, or up to $400 worth of Apple shares when you deposit $100,000 by 31st March 2025, 3:59 Singapore time. Make 10 US buy trades within 30 days from the first deposit and maintain the funds there till 30th May 2025. Not just that, Weibo is also currently running a live trading challenge where you can participate in and stand a chance to win up to $2,200. So if you're interested, do sign up to Weibo using my link down below. And let's get back to the video. In an article by Keith from the Investment Modes, he pointed out that during this period, vehicle registration sales in China have been on the rise, which is strange because if the economy has been slowing down and people's livelihood is at risk, buying new cars would have been the least of their concerns. Not just that, China's industrial sector has also been picking up steam. They are increasingly becoming an auto exports powerhouse, and there have been innovations in the energy sector, EV sector, and more. Then, of course, there's the AI boom, where the arrival of DeepSeek showed that Chinese companies were not only able to work around the US chip ban, but were also able to come out with a model that is both better and cheaper to run. This also sparked the start of the AI competition in China, where both Alibaba and Tencent also reviewed their AI model while claiming that they are better than DeepSeek. This shows that China doesn't have a competitiveness problem, but rather a confidence problem. And how do you go about solving that? That's right, you print more money! Oh, sorry, that one is the US, but same lah. So, in September 2024, the Chinese government unveiled its most aggressive stimulus package since the pandemic. This includes reducing reserve, lending rates, and mortgage rates to boost liquidity and lower funding costs, lowering the down payment required to purchase a second home, supporting the stock market by funding stock purchases and share buybacks, allowing for a higher level of fiscal deficit to reduce taxes, as well as increasing government spending and allowing for more fiscal transfer to local governments. And almost immediately, there was a huge inflow back into the Chinese ETFs. But wait, there's more. In November, the Chinese government announced another $1.4 trillion package to tackle local government's debt problems, then another $41 billion plan in March to boost consumption, while planning to issue 1.3 trillion yuan in ultra-long treasury bonds this year, and laying out a bold target of 5% GDP growth this year. Not just that, in February, the Chinese president also held a rare meeting with the heads of some of China's biggest companies, such as DeepSeek's founder, Tencent CEO, Xiaomi CEO, BYD CEO, and even Jack Ma, who had reportedly gone missing after criticizing the Chinese government back in 2021. And in the meeting, President Xi said two very important things. One, he assured that government policies toward the private sector would remain unchanged. And two, he hoped that private businesses would get rich first and common prosperity can come later. One way to interpret this is that as long as you guys don't do anything illegal, we welcome you to get rich first. And by doing so, you will then be able to help give back to society. So with that being said, is the Chinese stock market really sustainable? Or is it just another pump and dump? Obviously, I can't tell the future because I'm not Vatko. But this time, things do feel a little different. For example, it's not often that the Chinese government would raise their fiscal deficit unless they are very serious about it. The government is actively supporting the stock markets now, investor confidence seems to be coming back, and even the Chinese economy seems to be recovering too. Not just that, even after this whole rally, the Chinese stock market still remains fairly valued, especially when you compare it against its US counterpart, which is rather overvalued now. Individual Chinese companies are still trading at a cheap valuation, and most importantly, while still being able to continue delivering growth and beating expectations. Now, of course, I'm not saying that everything will be sunshine and rainbows from here. In fact, the market can't just keep going up in a straight line, and it will have to retrace sooner or later. Instead, what I'm trying to say is that confidence is starting to come back, and it is now up to the Chinese companies to sustain this momentum by demonstrating that they can indeed deliver growth. So, with that all being said, should you invest in China now? If you ask me, personally, I've always held the belief that investing long-term into the S&P 500 will work out well. And by long-term, I mean at least 20 years or more. But as Keith from Investment Modes puts it, the more concentrated you are, be it in China or in the US, you live and die by that concentration. While you may celebrate their outperformance, it will eventually breed anxiety over the risk associated with that concentration. You think more about if the music will stop, what will cause the music to stop, and when will the music stop. Hence, he recommends diversifying your portfolio globally, even if you may end up with a slightly worse off return. So it all depends on what your risk tolerance is and what you are comfortable investing in. Or if you just want to make things simple, one easy way to deal with this is to just invest in an all-world ETF like VWRA or FWRA, where you aren't just investing in the US or China alone, but you are basically investing in the entire world. Basically, you won't buy the wrong stocks if you buy everything. Anyway, do let me know what you think. Will you be investing in the China market, or do you think all in into the S&P 500 is still the way to go? Like, share and subscribe, as I'll be posting new videos every Monday, Wednesday and Friday.